Good morning and welcome this morning to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab, and I'm joined out there in the chat by my good friend, Cameron May, 20-plus year veteran of the financial markets. Cameron's there to help answer questions along the way. Well suited to do that. Thanks to all of you for joining us, whether you're here for the first time or the 100th time. And whether you're joining us live or in the recorded version, certainly, of course, welcome to all of you. You know, I say this every time. It's an interesting time to be in the market today. Certainly, as we see some big market movements. We're going to talk about that in the context of index options and what index options provide in way of a strategy. And we're talking about the process of using volatility to our advantage. And that isn't necessarily just true of index options, but we'll talk about some of the unique characteristics of index options along the way. So if you've ever asked the question, well, how can index options help me in a market condition like I'm seeing right now? Hopefully we'll be able to answer that question. A couple of quick housekeeping items, though, as we get started here. Remember, everything we talk about simply for illustrative and educational purposes only. It is not a recommendation of any particular security or strategy. Remember that equity and index options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option transaction or strategy. Also, remember, and I think it's worth talking about here, at least briefly, that multiple leg option strategies may involve multiple transaction costs, and that spread trading must be done in a margin account. Now, we're going to be using technical analysis today as part of the discussion, also probability analysis. Neither one of those guarantees as to the direction of the market or to future success. All of those methods of analyzing the market are theoretical. But Schwab doesn't recommend the use of technical analysis as a sole means of investment research. We're going to be using the Thinkorswim desktop software platform, specifically the paper money version. It is not a guarantee of future success out there in the real world. However, it's a great sandbox to learn and explore. Just be aware of the differences as you move from paper trading to live trading. Now, remember that investing involves risk, including the loss of principal, and that past performance of any security or strategy doesn't guarantee future results or success. Now, when we talk about stop orders, we've talked about these before. Remember that stop orders, which designate a point at which that trade might be exited or entered. We can use stop orders for entry as well. Allow us to specify the activation price for that order, but not the execution price. And so there's the potential, and also in the case of a stop limit order, that order does not get filled, or it gets filled at a substantially different price than was expected. The last thing I'm going to mention here is we've used index options as a means to hedge portfolios. We're going to talk a little bit about that today, but hedging and protective strategies will involve additional costs. They don't assure profit. They don't guarantee against adverse movement. And so we will discuss that in the context of this webcast today. Now, a couple of quick things. Tomorrow morning, I'm getting on an airplane and I'm flying to Detroit. I'm going to be joined by my good friends Ray Kimbrell and Scott Durfee. Kevin Horner is going to be there in Detroit. We're going to be teaching technical analysis and option strategies on Friday and Saturday. So if you are in the Detroit area, you want to come and join us at the Detroit Marriott at the Renaissance, come on down. We've got a little bit of space left, but not much. So if you do that, maybe get in touch with your local branch and have them get in touch with us. We can get you reserved. We can get you in the door. Then we're going to be in Denver doing the same thing, technical analysis and option strategies on May 2nd and 3rd at the Gaylord Rockies. That's a phenomenal property. That's going to be a lot of fun. That's also going to be Kevin Horner. I think that's also going to be Barb Armstrong there, along with me, Ray Kimbrell, Scott Durfee. And then we're going to be in Anaheim at the end of May. Beautiful time to be in Anaheim, California. May 30th and 31st, we're going to be teaching our advanced option strategies workshop, where we also include the discussion of index options as well as the discussion of futures content. So join us for one of these events. These events are at no cost to you. We'll even buy you lunch. So join us at schwab.com/events to register for any of these particular event. So let's do this. Let's pop over to the Thinkorswim desktop software platform, and let's talk a little bit about what's been going on. And by the way, again, thanks to all of you for joining us here this morning as we get into this discussion. So today is this is D plus one, right? Tariff implementation day plus one, or I guess this is day of tariff implementation. And so the market's perhaps, I think, a little bit more sedate somewhat, at least the equity market, a little bit more sedate somewhat than was perhaps expected. Taking a look here at the S&P 500, seeing a little bit of a kind of a long-legged, almost doji, maybe a little bit of an inverted hammer type candle here, but certainly seems as if there's a bit of a support level being established here, down around this 49.40 level or so. Some testing or price discovery below that level, but that area has been holding up, at least at the moment. Now, in times of volatility, right, in times of uncertainty, and that's certainly certain uncertainty, in times of uncertainty when there are extremes in the market, it's perhaps a wise idea to give areas of support and resistance a wide berth when it comes to assuming that those levels are going to hold. And one of the things that we talk about quite often, we teach in the technical analysis workshop. Cameron teaches in Getting Started with Technical Analysis when he talks about, in that webcast, when he talks about determining where levels of support and resistance are, talks about the idea that these are areas on the chart, not bright lines on the chart. We don't draw these with fine point pens. We draw these with big fat magic markers or wide paint brushes, because the market just doesn't work in that, 6 significant decimals of precision when it comes to levels of support and resistance. They become areas. And I think that's kind of what we've got going on here, especially in areas of high volatility, right? SPX kind of bouncing up off of that support level. I'm going to draw that support level in, and we'll just kind of establish that here on our chart as a potential level of support. Now, does that mean it's going to turn around and come up from there? No, it doesn't. Even though we're starting to see the RSI flattening out down in that lower reversal area, deep in that lower reversal area, news can certainly come in and change this. We've seen it happen in the last few days, where we've seen these big wide-ranging candles, and that's added uncertainty to the mix, and that's certainly added, again, certain uncertainty. That's certainly added uncertainty to the mix. Here's the NDX. This is the NASDAQ, the technology-heavy NASDAQ, a little bit sharper hook on the RSI back to the upside. We're seeing that gap up and sell off yesterday. We're now seeing kind of this, what if we were to look at it in the context of the candle, it's a little bit of an inside day. Pat Mullally and I used to call this a low bullish harami, in that we had a big red outside day, a big red day, right? Downward momentum. And then you get this little tiny candle, green candle, coming inside the range of the previous day and inside the body of the previous day. So technically a harami type candle, right? Small body inside a large body. That's apparently the transliteration for that, right? But what that might suggest, and the fact that it is low within the body of the candle as opposed to high within the body of the previous candle, suggests that maybe there is some room for upward movement within the day. Doesn't mean that it's going to expand beyond that day, right? It doesn't mean that it's going to bounce, but it just means it's inside that range. There maybe is a little bit of buying present. So a little bit of buying stepping into the NASDAQ here in this particular case. Again, guys, I'm gonna make this statement more times perhaps today than I have in a long, long time, and that is wide berth, big levels, big areas of support and resistance. You can see news flows changing markets quickly and to a large degree when there is this much uncertainty in the market. And we take a look at the Russell 2000, and the Russell 2000 kind of not inside the range of yesterday's candle. We would look at this maybe being the first or the second candle, potentially, if we get a reversal here, that second candle in what we might call morning star, or some traders might call this the beginning of an abandoned baby, right? Where you have a down candle and you have a gap down, and then you have a gap up and a move higher. So abandoned baby generally is a little more extreme here. This is perhaps a bit more of a morning star, but this is going to depend on follow through. And again, this can see some downside movement. We've got this doji candle right now. Not really a long-legged doji, a little bit of an unbalanced doji, not equal distance high and low. Now, why am I getting in so deeply into candles? Because these candles tell a little bit of a story, right? They tell a story of this uncertainty. Now, how does this relate to index options? Well, these are the indexes, right? NASDAQ, Russell, and S&P 500 that kind of express what's going on in the broad market. So the reason I wanted to start here and talk about this in the context of index options is to help establish some levels that we might use as reference points, but also to establish that idea of a broad berth, a wide berth around some of these areas as we potentially look at putting trades on. And we've done that before with, say, for instance, our 14-7 strategy. If you've been with us in this webcast before, we give markets a wide berth, especially when there is higher volatility. That process, that strategy naturally does it because of where we select the strike price and how we select the strike price. But that might be a caution to think about in these markets. It is tempting when implied volatility, and I'm going to pop over here really quickly to the VIX, to my VIX grid. When implied volatility is as high as it is, and with the inherent nature of volatility, VIX especially, to be mean reverting, it's especially tempting when you see implied volatilities on indexes that are in the 200% range or more to sell closer to the at-the-money position, assuming that there's going to be some kind of a reversal. Let me ask the question, and you don't have to answer, but how many of you have been looking for the bottom, right? Looking for that evidence of a reversal. There's no shame in that because I've been doing the same thing, right? Trying to say, well, this is the reversal. This is where the bottom is. And generally, we're not very good at picking where the exact bottom is. We may be a little bit better at finding it after it's happened. But, so the circumstance, that the Goldilocks circumstance, I think that a lot of traders are in at the moment. And I've got now the S&P 500 here. Yeah, right. I mean, this is what everybody out there on X is doing. By the way, on X, you can follow me. You can follow Cameron May. I'm at Ben Watson CS. Cameron is at Cameron May CS. The other coaches in the coaching department are similar naming conventions. You can follow us out there on X. Cameron's got it up there at the top of the page. I appreciate that. But kind of the Goldilocks scenario that everybody's searching for, at least out there on social media and X and everything else, is this, right? Looking for the VIX to come down, so volatility to contract so they can sell some volatility, and for the market to turn up, right? We're looking for this range between the SPX and the VIX to kind of collapse on one another, right? Moving back towards each other. Do we know that that's happening? No. I mean, look at where the correlation is. These are kind of, opposite ends of the spectrum. That correlation between the VIX and the SPX is at its kind of, it's nadir here, down at that -1, right? These are at polar opposites to one another. And we typically don't see a lot of positive correlation unless there's something unusual. So this is an extreme, but it's not an unusual extreme necessarily. Yes, granted, the VIX has gone higher than it has in a while. And it stayed there a little bit higher, unusually so over the last couple of days. But that's because there is kind of this floor of uncertainty, this liquefied floor, if you will, right? So now, cheering for 16, looking for a VIX to come back down, right? But so now, what do we do with this? I mean, I guess that's the question, right? What is the scenario that we might utilize index options for? And that's where John will likely be in San Diego again in January of 26. Typically, we come to San Diego in January because it's nice and warm there. and we live, the coaches, at least myself, Scott Durfee, Cameron May, we all live here in Utah where it is cold in January. San Diego is warm in January, so that's where we like to go at that particular time of the year. So does everybody else, right? But that kind of presents us with this scenario. So let's take a look at kind of the scenario here that's presenting itself. With markets having moved down and with potentially this finding of a little bit of a level of support and VIX coming in or contracting a little bit, let's see if we can put together a strategy that might benefit from that scenario, right? So let's do this. And I'm going to do this let's come back to our index grid here. And I'm going to look again, there's the S&P 500. Here's the NASDAQ, which was giving us that little bit more of an inside day and a little bit sharper hook in the RSI like we talked about, right? Thanks, Cam, for bringing that up, that calendar of live events. Okay, so here's kind of that area. So what I'm going to do is I'm going to use this to our advantage. The fact that we've got this little bit of a maybe bear, what was starting to be kind of a bear flag type of pattern. By the way, in a couple of hours, I'm going to be teaching trading price patterns for Barb Armstrong. So we'll talk a little bit more about bear flags and bull flags. But looking for this opportunity to maybe sell somewhere outside of where this area is, right? Where this range of support has established itself, okay? So if we were to do this, let's use the NASDAQ as our example here in terms of capitalizing on high implied volatility that's falling and selling outside of a range, right? So here's where we're going to find maybe some opportunity as an example. So I'm going to go to the trade tab here while we're on the NDX, all right? We're going to take a look at the NDX. Now, the NDX, just one of a bunch of indexes that we've looked at before that are European style indexes, which means that short options, well, okay, it means in general that options cannot be exercised until expiration. So what that means is if we are short an index option on a European style option, we don't have the risk of early assignment. It doesn't mean that it can't move. It doesn't mean that price can't move. It just simply means that if we're short that option, it's not going to be assigned early the way an American style or single stock option contract might be if we were short that option. There's that potential for early assignment risk. So you can kind of see over here on the right-hand side of this option chain how those implied volatilities are bleeding off pretty quickly in the short term. The expiration date today, right? These options that are expiring today are about 118% implied volatility, implying about a $389 move up or down in this index. And then you can see that that kind of shrinks a little bit in terms of implied volatility. But what happens is the range of potential movement grows. You see that implied daily move or implied move within that time frame. So this would suggest that selling an option or creating an option here expiring tomorrow has high implied volatility, and between now and tomorrow, about a $720 move up or down in the index, right? So what this higher implied volatility does is it means that those option premiums are a little richer, well, a lot richer potentially, meaning juicier, meaning there's more implied volatility there. If we go down to the bottom of this option chain to today's option statistics, we can see that this current implied volatility percentile is in the 100th percentile, right? That means over the course of this last year, 52-week range, right? Between the 52-week low of implied volatility at 14 and the 52-week high of implied volatility at 48, and implied volatility is, which if you were to just pick it kind of in the middle of the range, runs about 20%, 25%. That implied volatility up here in where we are now in the 90%, 85, even 66% is extremely high. That's still at the 100th percentile, right? Even if we go 5 days out from now, right? Or 6 days or 7 days, a week out from now. Let's go out to that week out from now. That's 16 April. That's next Wednesday. And let's look at the possibility. So what that means, higher implied volatility. I've got 100 strikes in here, 50 up and 50 down. What that means is to get an equivalent amount of premium, an option seller could sell further away from the at-the-money position, meaning giving the market a wider berth for the same amount of premium bringing in, right? So that gives a little more latitude, a little more range for swings to happen. That's the gift of higher implied volatility. The dark side of that gift is higher implied volatility that blesses us with that gift of wider range also means that there is the potential for bigger movement within that range or beyond that range. So now let's come back down here and let's see some of these prices. You can see where some of these prices, and again, these are expensive options because this is a big index, right? But we're going to use them in a way, because look, I mean, I have to go like 20, 30 strikes just to get to that 30-cent delta, kind of that 2/3, 1/3 probability range. I'm at the 1810 strike on the call side, and on the put side of the equation to get to that 30 delta, because puts generally tend to be more reactive to changes in implied volatility because they're used for protection. I'm going down all the way, for instance, to the 16,550. So let's look at see where that 16,550 is on the chart. So 16,550 is coincidentally right off the bottom of that candle 3 days ago. 16,550 is right there off the bottom of that. Okay. So Fred, let's argue. Let's have this argument, right? So I'm perfectly willing to hear your perspective on implied volatility, right? Doesn't mean VIX increasing does not mean that the market will go up, right? Absolutely does not mean the market will go up. The VIX rising and the VIX being elevated means the market could move. So do we know that this is going up? We do not. Can we sell premium around this in the event that the market does nothing, in the event that the market moves down, or in the event that the market moves up? 100%. So let's talk about that as we look at this potential for selling that elevated premium. Let's go back to our trade tab. And let's go to our 16,550, which is right down here. That's our 30-cent delta. Okay, 16,550, selling 337. We're going to sell that put option for $336 per share times 100 shares in the contract. If we were to just leave it right there, just sell this as a cash secured put. Because remember, this is cash settled. This is a cash settled index. That's a pretty, whoops, I sent that order off. I don't have enough capital in the account to do that. Let's see if we can do that again. Sell, we'll look at confirm and send. That's $1.6 million. That order is going to get rejected, right? That's our maximum theoretical loss. And that's what we're going to have to hold in terms of capital to account for that potential, right? So what we're going to do is we're going to define the risk. And this is one of those scenarios. If we do a 16,550 sold put and we buy a 16,625 put, that's where we have that potential. Let's see if we did that again. Let's see, 16,550. We're going to sell it, and we're going to buy the 16,625. There it is, $8.20 credit, and it's bouncing back and forth because this is moving. And we look at confirm and send. Potential on the trade is the premium that we're bringing in, $8.15 against our maximum loss in the trade of 1685. This is defined risk without early assignment risk, and we've reduced we've reduced our capital impact. We've reduced our buying power impact to simply the maximum theoretical loss in the trade. And what that does is it gives us a potential range. Now, that's a lot of premium for a $10 wide, right? Actually, I'm sorry, that's a $25 wide spread here. The width of that spread is $25 wide. So bringing in $8 is still a lot of premium to be bringing in for that range. So what if we were to do this? This was at the 30-cent delta range. Let's go outside that range a little bit. I'm going to cancel this order right here just for a second. The one that we inadvertently put on. And let's go outside this range a little bit. Let's go out, say, for instance, to the 20-cent delta. Okay. And we're going to go to about the 20-cent delta. And in fact, we've got to go way, way out here. Let's go to the 22-cent delta in this case, 61.10. Let's just cross-check this against the chart. And 61.10 is going to be way down here. Right? 61.10 is going to be way down there. Okay. All right. So outside that range. Now, here's the thing. If we do that, let's go back to our trade tab. 61.10, right? Or 6100, excuse me. 6100, selling the 6100 and buying the 60.75. We're bringing in about half the credit, but we've increased our likelihood of success here by about 10%, right? We've gone from a 30% probability of being in the money at expiration to a 22% or 20% probability of being in the money at expiration, which means that we've gone up from, say, for instance, a 70% probability of success to about an 80% probability of success. And we've cut our premium about in half, but we've given ourselves, again, a broader range in which this could move, right? In which the index could move. Still a risk-defined trade. We're going to click on confirm and send and read through this order. Maximum loss goes up a little bit, but our premium goes down. So we've increased our maximum loss, but the likelihood of taking that maximum loss is significantly lower in this particular case. So I'm going to put this in our index options group and we'll click on send. Now, here's the thing. If it goes up a lot, great. If it goes up a little bit, okay, that works for us too. If it goes sideways, if this index goes sideways, that's fine too. If this index comes all the way down to where our break even is, which is 16,095, right? 16,095. From that standpoint, that gives us a cushion where we could be wrong in terms of direction and still potentially make some money or at least break even in the trade, right? What hurts us is if the price goes down and it goes down significantly down through our short strike and through our long strike. But remember, we can't be assigned early on this short vertical spread. So we're going to go ahead and we're going to click on send and we're going to fire that order off and we'll see if that fills. All right. Okay. So I want to address Carol's question and as well Abshorka's question. All right. So here's the thing, Uncle Pringle. When we talk about open interest and volume, it may take us a while to get these filled, right? So we might look for something that is an adjust to one of those strikes where there potentially is some open interest and volume, but this is a very liquid product, right? So it's likely that at some point we're going to see some action at those levels. Again, that's something to pay attention to as we put these trades on. I wanted to get the concept out there, but let's take a look. I'm going to go back to my monitor tab here really quickly, and there we go. Now our trade sold. We got $6.10 for it. Now, yes, we can, Leon. We could put a stop loss on that. But we don't necessarily have to because we've planned for that maximum theoretical risk in the trade. So here's our positions, our stock portfolio, right? And we talked about this last week where the stock portfolio has a lot of different positions here, okay? And we bought a long put option on the Russell 2000 to offset, to provide that offset. To go back to the question that Abshorka asked, does it make sense to buy protective puts to protect long positions against further loss? We did that as the market was moving to the downside and volatility was increasing. That benefited us, right? That volatility increase and the downside movement benefited us significantly, because that put option, the value of that put option that we bought for $56.90 per share is now trading at $291 per share. So we've seen an increase of about 411% in that put option. So it's likely in this particular case that taking that trade off at this point, where we're now 21 days to go until expiration and implied volatility is falling, the VIX is coming down, it has been, is a beneficial scenario, right? Harvesting some of that gain. That's offset some of the loss that we've seen here in these stocks individually in this portfolio. Has it offset all of it? No. But it reduced our delta exposure, our directional exposure, to the tune of about 92 deltas. That tells me that this option is in the money, deep in the money. And if the option still keeps going down, it's only going to get to a delta of 1. So it's got limited gain that it can continue to do for us. So what we're going to do is we're going to close this one down. So I'm going to create a closing order and we're going to sell this one and harvest that potential gain in this particular case. Now, again, this is an illustrative example. We bought it for $56. It's currently trading at $279 per share. So we're going to go ahead and we're going to click on send and fire that order off, and sold it for $289.85. All right. We placed that last week, Melissa Etheridge. Or Eldridge, sorry, Melissa Etheridge. That was the you probably get that mix up quite often, I'm guessing. All right. Now the question is, well, should we still buy a protective put option? And I liked what Laura says, right? Protective puts at this point might be insuring an already wrecked car. It's a hindsight thing, right? But that typically tends to be the reaction of the market, right? When the market moves down and when the horse has already gone out the barn door, we close the door, right? Well, the horse is already out the door or the car is already wrecked. So here's the scenario. Could this still go down more? Yes, 100%. We know that, right? But we go back to that VIX grid. We say, look, what's volatility doing? Buying a protective put at this particular point where volatility could potentially continue to move to the downside, right? When volatility could potentially move to the downside, suggests that we're buying a really expensive put that's going to be sensitive to a collapse or a crush in that volatility, right? Unless there's much, much bigger structural problems, which there might be, I don't know, that we see a reduction in this VIX, that volatility goes down. Could it spike again? Yes. I just want to be clear about that. But the fact is, in this particular case, buying a long put option in this particular case may be a challenge simply because it may suffer from that potential collapse in implied volatility. So buying a protective put might not be the best approach to hedging. That's why using something like, so let's go back to our portfolio here and say, look, now we're sensitive to this portfolio to the tune of about 196 long deltas. But what if we were to move that short vertical spread that we just traded, this short vertical right here that we just traded on the NDX, what if we were to move that over to our stock portfolio and use that as some of that hedge? We brought in a little bit of premium here. Let's right click and let's move this to the group stocks. And let's come back down here and see what that did to our, there's our totals right there. It reduced our deltas somewhat. Now, wait, hang on a second. We need to change our beta weighting, right? We need to change our beta weighting to NDX deltas and not Russell deltas. We got rid of our Russell hedge. Now we're using that NDX hedge. Oh, wow, we reduced that sensitivity substantially. So we're using the type of hedge that benefits us based on what implied volatility is doing. Does that make sense? Okay. All right. Now, I want to do one more thing here really quickly while we've got a few minutes left. And this is the strategy that we've been doing on a regular basis, and that is on the SPX, right? Let's go back to our index grid. On the SPX, we've been selling. If the market has been below the 200 period moving average, we've been selling call spreads. When the market was above the 200 period moving average, we were selling put spreads. But since we're still below the 200 period moving average, we're selling call spreads. And we're doing that at the 1 standard deviation line 14 days out from expiration. Okay? Selling a call spread 14 days out from expiration and buying it back at 7 days to go until expiration. So let's go over here to our monitor tab one more time. I'm going to close up my stocks group, and here's our index options weekly strategy. We sold the 5,900, 5,950 short call vertical on the SPX last week. We sold this last Wednesday, and we sold that vertical spread for $4 of premium. It's now trading at a zero bid because it's gone so far out of the money that essentially there's no value left in it, even with 7 days to go until expiration. So some traders are going to say, well, why don't we just leave it in place because 7 days to go, it's at zero, it's going to expire worthless. And that's the likelihood. And there's no risk of early assignment because it's an index option. The problem is, could the market rip our faces off to the upside? Yes. And this $4 spread that we sold that's now trading at a zero bid could end up becoming expensive again. So if the market rips our faces off to the upside, we could very likely get ripped our faces off in this vertical spread. Does that make sense? So the strategy has been based on the premise of buying or selling at 14 days, buying it back at 7, come what may, right? So we're going to do that. We're going to close this one down and see if we can close it down. We might not be able to close it down. We might have to work it off one leg at a time. So we're going to buy this back at a zero bid right now, but it may kind of bounce around a little bit. Not likely that we're going to see a 5-cent credit to buy back a vertical spread. So I'm going to give it a little bit of range. I'm going to be willing to buy it back for a nickel. And we're going to hit confirm and send. Read through the order, make sure that that's what we want to do. I'm willing to sacrifice $5 out of our 400 to get out of this trade. And we're going to go ahead and click on send and fire that order off. And we got it at zero bid. That's fine. Great. Now, that's paper money. Be aware of that fact. It may be harder in live trading to work that trade off. And you may have to separate the legs out and walk them off one at a time. So now let's go back to our chart and let's put our next iteration of this trade on. I'm going to change my grid to our index options grid here on the SPX. You know, I haven't, but I will. Thanks, Martin. That's a great question to ask. All right, so here's what we're going to do. I'm going to go to the trade tab, and we're still on the SPX. I'm going to go, I know that my next 14-day expiration is the 23 April expiration cycle. That's 14 days to go until expiration. So what I'm going to do is I'm going to go to the chart, and I'm going to say, all right, over here on the, we know what this is doing, so I'm going to expand this cell right here. So we're going to go to the what did I say, 23rd? 23rd of April. Yep, 23rd of April. So I'm going to put a time hack here on the 23rd of April. I'm going to grab my drawing tools, and I'm going to use that timeline right there. So 23rd of April. There's our time hack, right? So that's just a horizontal line, or excuse me, a vertical line at that 23rd of April. So what I'm going to do is I'm now going to come up here. I'm going to change this back to my trend line, and I'm going to look for that intersection. I'm just going to make an intersection right there. So where is that likely to intersect? Right there. Okay. So what is that level? 54.90. All right. 54.90 is now what we're going to look at as a selling point for that short strike. So we're going to go to the trade tab. We're going to come over to the call spread side because remember, we're selling call spreads because the market is below the 200 period moving average in this particular case. So we're going to go to the 54.90. I don't know if we're going to get to 54.90 with only 100 strikes. We might have to go out to 150 strikes, which is going to be 75 up and 75 down, 54.90. We're going to get it? No, we're not going to get to it. Here we are. Yeah, there we are. 54.90. The 11-cent delta, and we're bringing in $18 for selling the 54.90. So we're going to go 10 wide, sell the 54.90, and buy the 5,500. And now we're back to bringing in $1.30. That tells you the likelihood of that implied volatility collapsing from where it is to where it's likely to be 14 days from now. Could it expand again? Yes. But the fact that implied volatility hit that high and is now lower, and the fact that implied volatility has worked its way off, if we look at the option chain from where implied volatility is now, today, 118%, to where it is for that expiration series on the 23rd of April at 59%, it's coming down more than half implied volatility. That implied volatility working its way off. So let's bring our trade back up here from the bottom. And $1.40 on a $5 wide, on a $10 wide. That's not bad. That's what we've been getting, somewhere in that range, and we're bringing in that premium. Our maximum theoretical loss in this trade, 890. And where would this have to be in order for us to get to that 890 maximum theoretical loss? The index would have to be back up above 5,500. That would be a rip your face off rally in the next 7 days in order for this to get there. Could that happen? Yes. Your face could get ripped off quickly. But this is playing the probabilities. 11-cent delta, which means this has about an 89% probability of success in this particular case. And again, that's trend agnostic. That's simply looking at the option probabilities as expressed by delta, which is at its core a sensitivity expression to directional price movement. So we're going to put this in our index options weekly group. We're going to go ahead and we're going to click on send, and we're going to fire that order off and see if that order fills for us. But that's kind of the way that we've been using index options. We sold it for $1.30, and let's go back to our monitor tab and take a look at where we are. Sold it for $1.30. If implied volatility collapses, that works for us. If the market goes up, that works not necessarily for us, works not necessarily against us until we get up to where we're selling that at the 54.90. If the market continues to stay sideways, great. If the market goes down, that works in our favor. But come what may, we're going to buy this one back and sell another one next Wednesday, 14 days out from there, 7 days from today. So that's the strategy we've been talking about, guys. And again, some of the reasons why we use index options because of that lack of early assignment risk. If you want to learn a little bit more about it, come over here to the Trader Talks webcast page on YouTube and type in index and just hit index. And now you're going to get trading index options, intro to index options, how to trade stocks, selling index option spreads weekly. That's what we've been doing. Zero DTE index calendar spreads. So what we've done today, guys, we used a short vertical spread on the SPX wide berth to hedge against potential downside movement, bringing in a little bit of premium. We also took off that long protective put on the Russell 2000 that was offsetting potential adverse movement in our portfolio. That one worked in our favor. And we managed our 14.7 index vertical strategy as well on the SPX. Guys, thanks very much for your conversation in the chat, and my thanks to Cameron May. By the way, click on subscribe while you're here on the Trader Talks webcast page or on the bottom right-hand corner of the screen. Click on that subscribe button. That helps you to stay connected to the Trader Talks webcast channel. My thanks to all of you. My thanks to Cameron May, and my thanks to our great production staff for helping to bring this webcast to you guys. I'll see you in about an hour or so for trading price patterns. We'll see you then. Take care, everybody. Bye-bye.